Hello, my name is Sandeep Varma. I'm the president and CEO of ATS Wealth Management. Today, we will provide a market update for July. We'll start with a recap of returns through the first half of 2023, and then we'll shift our discussion on the Federal Reserve, our outlook on monetary policy going forward, and how we view the landscape for investors for the rest of the year. So, beginning with the performance recap, the month of June was a stellar month of performance for stocks across the board. The S&P 500 index rallied 6.61% in total return, while small cap stocks led the way, finishing June higher by more than 8%. International stock lagged the U.S. market, but still finished the month firmly in positive territory. International developed markets, represented by MSCI EFA Index, rallied 4.58%, while emerging markets were higher by 3.9%. For the year, the S&P 500 Index has now rallied nearly 17% and sits just 5% below all-time highs. For international developed stocks, the MSCI EFA Index is higher by more than 12% on the year. In bonds, both taxable and municipal indices remain in positive territory for the year, with the taxable Bloomberg U.S. Aggregate Index up about 2.1% in total return, and the Bloomberg Muni Index up 2.7% through June. So far this year, higher starting interest rates and coupons have allowed bond investors to clip their higher coupons and remain insulated against short-term fluctuation in interest rates. It's been quite a year for mega cap stocks in the US, which have driven majority of the returns year to date. Optimism around artificial intelligence, or AI, has helped fuel the rally in technology stock through the first half of this year. The 7 largest stocks in the S&P 500 now make up more than 25% of the S&P 500 index. These stocks consist of Amazon, Apple, Google, Meta, which is Facebook, Microsoft, Nvidia, Tesla, have returned on average approximately 80% so far this year. The average year-to-date return for the rest of the stocks in the S&P 500 is just shy of 6%. Apple, the largest company in the world, now boasts a market capitalization of approximately $3 trillion. This is larger than the entire combined market cap of the Russell 2000. We believe that the concentration of U.S. indices in mega-cap tech stocks highlights the importance of diversification over the long term, even when it doesn't necessarily work in the short term. Shifting to the Federal Reserve, the central bank paused on rate hikes at its most recent policy announcement on June 14, which was largely in line with market expectation. The more interesting part of the announcement came from the Fed's updated summary of economic projection. In the update of these projections, the committee members were a bit more hawkish than we would have anticipated, with a medium member of the Fed expecting 2 more rate hikes before year end, with a peak rate around 5.6%. As far as the markets are concerned, the futures are currently pricing in about a 75% chance of an additional 25 basis point rate hike in the next Fed meeting in July, with a much lower chance of any additional hikes going forward. If core inflation readings continues to move sideways, the Fed's forward guidance should give them some much needed breathing room to potentially take interest rates higher if warranted. In addition to the outlook on interest rates, the central bank also provided upward revision to their expectations for the economy. The Feds now expect the U.S. to grow real GDP by approximately 1% in 2023. up from the first quarter estimate of 0.6%. In addition, they are forecasting the labor markets to remain strong, with the unemployment rate gradually moving higher from the current levels of 3.7% to around 4.1% by year end. Even though we do not anticipate that the Feds will begin cutting interest rates anytime soon, we are confident that they are nearing the end of their rate hike campaign. Since 1980, there have been 9 distinct periods where the Feds have raised rates. Looking back at the end of the previous rate hike cycles, the stock market usually performs quite well, with plenty of volatility in between. This chart shows the average 6-month and 1-year return for various indices following the last rate hike. Markets are forward-looking and tend to discount uncertainty, particularly when it comes to key issues such as monetary policy. When the Feds eliminates some of that uncertainty, investors tend to respond positively. This doesn't necessarily mean that the worst is behind us, and the prospects of the Feds pushing the economy into a recession is still a significant risk. However, staying out of the market until a potential recession is over doesn't usually make sense either. History also tells us that the stock market tends to be in an upswing by the time recessions are over with. Bringing it all together, let's talk about how we are positioning portfolios ahead of an expected pause by the Federal Reserve. First and foremost, each investor has their own unique set of objectives and liquidity needs that will guide their appropriate long-term asset allocation. Uncertainty will always be a feature of the market, and diversification is crucial. In stocks, the near-term outlook is less certain. However, we believe that valuation across most areas of the global equity markets are at relatively attractive levels, particularly when looking outside the US to the areas like Europe, Japan, and emerging markets. In bonds, we have a very positive outlook with more clarity around starting rates. For investors with a short-term liquidity need, money markets and other short-term bonds are providing attractive returns with very low risk. For investors with longer time horizon, sitting on significant cash or equivalents like money market or short-term CDs, we believe now is a good time to start deploying those funds into longer dated bonds to lock in higher rates and avoid the potential reinvestment risk of these shorter term instruments. So that's what we have for this month. Thank you for watching. Thank you for your trust and confidence that you have placed with us, and we'll see you next month.